Dear students, welcome to a session on marketing of financial services. Today, we would initiate with unit number 3, that is insurance, and the topic which is available in this video is Introduction to Insurance. Before moving into the details of what we are going to cover, let us try to understand what are the learning outcomes which we are going to have after going through this video. We'll try to understand what is the difference between risk and perils, how savings and investments are related to insurance. We'll try to understand the concept of insurance, and in the later video we'll try to understand what are the principles of insurance. Before moving, let us try to understand what is called as uncertainty and what is termed as surprises. As you are aware, in life we are undergoing a number of uncertainties and surprises. In context to insurance, let us try to look into with respect to various examples. First example given is all of a sudden someone falls ill and is admitted to a hospital. That is uncertainty. He never predicted nor anybody wants to get admitted in a hospital. Motor vehicles are stolen and people die or get injured in accidents involving motor vehicles. Houses or belongings are destroyed by fire, maybe because of an error or man-made, either or but destroyed by fire. Large-scale loss of lives and destruction of property in cyclones and tsunami. From these examples, we can conclude that life is full of uncertainties and surprises. Uncertainty, something which you never expect happens. Surprises is something which happens and it creates a problem for you. You never thought of that. So, when life is full of uncertainties and surprises, protecting oneself, one families and society from these uncertain events is a prerequisite of an individual. Moreover, this has been a biggest concern for man for centuries, that is uncertainties and surprises. These uncertainties and surprises have led to understand two important words. The first is risk and the second one is peril. Let us try to understand risk. The chance of suffering a loss as a result of uncertainty, that is feeling of not being sure what will happen in future. I don't know if I'm working today how long I would be working in an organization tomorrow. There could be a lockdown of the organization, I may have to quit. That is also an uncertainty. You are studying today, what will happen after completing a course? Will I get a job? Will I get a package of 5 lakh? Will I get a package of 6 lakh? Is uncertainty. You're working in an organization since last 5 years, but you never know what would happen to that organization due to internal factors or external factors. That is what is called as uncertainty. But dear friends, we are trying to understand that risk is there is a chance of suffering a loss. This loss which is suffered is due to uncertainty. The events that gives rise to these risks are called as perils. Means perils are the events which are going to give rise to a risk. Like tsunami is a peril, fire is a peril, steel to be stolen is a peril, and risk associated is you're going to lose something. If there is a fire in a building, it will cause damage to the entire building, entire property of yours. That is the damage you are going to face. That is what is the risk. So try to understand peril is a cost, risk is something which you suffer in terms of loss. That is what we need to understand. Similarly, as we have tried to look into what are the risks and peril, let us try to understand how savings and investments are related to the insurance. If you look at it, if you look at, we have n number of questions. Question number one that generally comes is it possible to reduce the financial consequences that arise due to above risk and protect ourselves financially? Here I have an example to quote. Suppose Ram, an MBA student, who has recently joined an organization on a package of 10 lakhs was earning was an earner for a family. Let us try to put into an example now. This student, while going on work or office, met with an accident. In an accident, he lost his life. Now, what has happened? It is lost to the family. Not only Ram is not there with the family, but also Ram, being a sole earner, was offering financial security to his family. Today, that amount of money which the family was getting for the daily activities which need to be carried out by the family would not be available from the day Ram met with an accident and lost his life. So, can we have a provision in such a way that when Ram lost his life, till the parents are alive, can somebody take a responsibility so that whatever was the amount Ram was giving as to the family members is offered by someone? That is what is a part which we needs to analyze in terms of insurance. Why? Because if you have saving, you're going to get saving plus amount which you have earned on the savings, that is in the form of interest. For example, I am getting a package of 1 lakh. After 12 years I will have, for example, 6 lakh rupees in my saving account, and whatever was the interest accumulated, 6 lakhs plus interest accumulated would be available to me in case I will have certain uncertainty to face. Above that, I will not have any money, because that is what was available with me. So making a provision by which you are going to get an amount which is pre-specified for uncertainty which takes place in your life is nothing but the term which we are related to or interested to know in terms of insurance. The examples which will make us understand better what is an risk, what is a peril, what is savings, what is investment, and what is insurance. A person dies suddenly. He is an important member of the family. Suppose he is an earner, let it be an earning of 10,000 rupees per month. Per year he is going to earn 1,20,000 rupees. And now suppose he dies suddenly, who is the other person who is going to give 1,20,000 rupees to a family? Person died suddenly, maybe an accident, accidental insurance, maybe health insurance. We need to find out that how these things would be compromised after certain uncertainty. A second example why health insurance comes into picture: a person suffer a paralytic stroke that leaves him permanently bedridden. Now the person, if is bedridden and he is running a business for the family, just imagine what is going to happen with the business. And second, who is going to take care of his family when the business is not been run? From where the money would be generated? The loss suffered is so large in all such situations that whatever you have saved is not sufficient to take care of financial burden. You need to have certain provision in which you can. That is what we need to understand. Let us move to the other part in which we will try to understand what is a definition of insurance. If you look on the slide, insurance is a mechanism of risk transfer and sharing by pooling of risks and funds among the group of individuals who are exposed to similar kind of risk for the benefit of those who suffer loss on account of risk. Let us take our own example. What do you mean by sharing by pooling of risk and funds among the group of individuals? Suppose there are 60 students in the class. Tomorrow they are going to get the job. Now there is a risk associated. Tomorrow you start a job, you have two risks clear. One is called as risk of your own. You might have an unfortunately an accident or an health issue which should come into picture. So everybody would like to get protected from these two things when you join the company. So what happened? All those students who go into the corporate world anticipates importance of accident insurance and health insurance, enrolls themselves for a health insurance or an accident insurance. In our college, for example, we have 60 students, all of them will get enrolled. So what is happening here? These 60 students have identified two risks. One is accident risk and other is insurance risk. These two risks are combined together and they calculate that what would be the risk value at and how many students will have that risk. For example, out of 60, calculations are generally there are 5 students who bear a risk of accident or insurance, and whenever there is an accident, the probable estimate economic loss would be of 1 lakh rupees, and for medical hospitalization, for example, it is 1 lakh. So we have 2 lakh rupees, that is what we need to 6 plus 6 12 students, 12 lakh rupees is to be collected. Then if the 60 students would like to purchase an health insurance or an accident insurance, accordingly that pool is created, that money is collected from all those 60 students, and any student who undergoes an accident or meets with an accident or health problem, this pool will help the funds in a way which will take care of economic loss of that particular individual. That is how, in a simple way, insurance is defined. Let us try to understand what are the different types of insurance in general. The tools, the general way, there are two ways or two important things of insurance. One is for social insurance, that is which is taken care by the government for the people who are working in the government organization, or there are certain statutory norms which are created are in a form of insurance. Most important is EPFO, that is Employment Provident Fund. It is a fund which is deducted from the salary of an employee, part of which is contributed by the organization, and that amount gets deposited as a provident fund, and over a period of time that fund would be made available to an individual. That would be in a form of annuity one time, or maybe in a form of pension if applicable. Such schemes are carried out by the government for the employees or for the people. Such types of insurance is called as social insurance. Also, there is one type which is called as ESI, which is Employees State Insurance Scheme. What is that? This is a scheme which provides medical care and other benefits to employees or employees provident fund organization. Now the issue is, if you are a member of this, you are going to get benefited. Apart from what government gives, which is termed as social insurance or the statutory schemes available, there are also certain schemes available which is called as voluntary private insurance, which is very simple, in which there is a group of people who opt to take insurance from the private companies. The people who are going to get the insurance is called as insurers, and those who are going to companies who are going to get insurers are one who gives insurance like a company. Insured is one who is going to go for an insurance. Premium is the amount which you pay as an insurance amount, and sum assured is fixed amount of money which an individual is going to get on certain on happening of certain uneventful un, uneventful or an event is called as. That is what we need to understand. I suppose at the end, on first part, we have tried to understand in very simple way what you can also take a notebook and try to write down by your own understanding what is risk, what is peril, and what is insurance. We can think of an example which is in front of you and try to understand this example in much clearer way by writing down the example which you can correlate to a word which is called as risk, peril, and insurance. Then we also try to understand what is the difference. Is there a difference between social insurance and private insurance? If yes, what is the difference? Then let us try to understand the words which are used in insurance. What is called as insurer. Insurer is a company who carries out an insurance. Insured is one who wants insurance to be done. Sum assured is amount which an individual is going to check. Individual is going to get, that is what is called as sum assured in case of mishappening. So, in short, if you want to make these terms very clear, just ask your parents to Ask your parents if they have any insurance of any form available with them. Take that insurance in front of you, write down which is the company which has offered insurance, what type of insurance it is, what is the sum assured, means we'll be in a position to understand what is insured, what is insured, and what is sum assured. With this basics, I would conclude my first video with respect to basics of insurance. Thank you.